Welcome to Tech Money Madness, your daily U.S. stock market deep dive. It is August 4th, 2026, and if you've glanced at your portfolio today, you might be experiencing some serious financial whiplash.
Oh, absolutely. I mean, it is just a wild day out there.
It really is. I mean, imagine running a massive global company. You make more money this quarter than almost any business in human history.
Right.
You absolutely shatter your own sales records. And in response, the market instantly wipes 10% off your stock value.
Yeah, which is exactly what happened to Apple today.
Exactly. Welcome to a market where the laws of physics have, seemingly completely reversed. Up is down, good news is punished, and speculative futures are heavily rewarded.
It feels completely counterintuitive on the surface, doesn't it? I mean, we're looking at a day of massive market cross-currents where the signals aren't just mixed, they are actively colliding with one another.
Okay, let's unpack this. We have a deep stack of sources today. It's a comprehensive daily market briefing that compiles the latest insights from CNBC, Seeking Alpha, and The Motley Fool.
A lot of ground to cover.
For sure. So our mission for you on this deep dive is to cut through the noise of these wild economic data points. We're going to extract the actual structural trends you need to understand the financial landscape right now.
And we really have to start with the broader macro economy.
Yeah, because the dashboard is flashing wildly contradictory signals, which kind of sets the stage for these chaotic stock movements we're seeing.
You really cannot contextualize a company's stock movement today without understanding the economic water it's swimming in. Take the latest numbers from CNBC, for instance.
The GDP numbers, right?
Exactly. The U.S. second quarter growth rate just slowed down to 1.5%. But at the exact same time, June core inflation is sitting at 3.3%.
Man, those numbers paint a very specific picture of an economy just slamming on the brakes. But, the briefing notes that this 1.5% GDP slowdown is largely due to declines in federal government spending and a drop in business inventories.
Yeah.
To me, that feels more like an accounting quirk than consumers suddenly locking away their wallets.
What's fascinating here is how the mechanics of GDP calculation can obscure the reality on the ground. When businesses draw down their existing warehouse inventories instead of manufacturing new goods, it registers mathematically as a drag on GDP. And the same goes for the federal government temporarily tightening its belt. Neither of those things means the average consumer has stopped buying groceries or, paying for streaming services.
Right.
So it's an accounting drag, not necessarily an organic economic collapse.
Okay, that makes the GDP number a bit of a mirage then. But the inflation conflict is what is really making everyone's head spin.
It's a tough one.
It is. CNBC is reporting on a recent manufacturing survey claiming that inflation worries right now are actually worse than they were during the peak of the pandemic era.
Which sounds terrifying.
Right. Yet, at the exact same time, alternative data points like real-time digital pricing indexes and global shipping freight rates are suggesting inflation is at its lowest in years. How can a manufacturing survey signal peak panic while real-time data says inflation is bottoming out? It's like driving a car where the dashboard says you're going 100 miles per hour, but the GPS says you're crawling in traffic.
That's a great analogy. It really comes down to the fundamental difference between the rate of change and the cumulative effect.
Okay, break that down for me.
So, the alternative indicators are looking at the raw momentum. They see that the rate at which prices are going up has drastically slowed down. That is the 3.3% core inflation figure.
Yeah.
It is objectively cooling.
Right, the speed is dropping.
Exactly.
Right.
But if you're a manufacturer running a factory, purchasing raw materials and paying labor, you don't care that prices only went up a fraction of a percent this specific month.
Because things are still expensive.
Right. You care that over the last 36 months, the baseline cost of running your entire operation has fundamentally shifted permanently higher.
Wow, so the compounding weight is what's crushing them.
The cumulative weight is exactly what's causing the panic in that survey. They are feeling the absolute permanent price level, while the headline data is just measuring the month-to-month speed.
Which puts the Federal Reserve in a brutal position. I mean, how do they steer this? Do they cut interest rates because the momentum has slowed? Or do they hold rates high because businesses are still suffocating under that accumulated baseline?
It's the ultimate central bank dilemma.
And just to complicate the Fed's job even further, we have major geopolitical stress. The European Central Bank is currently facing intense pressure to completely rethink its interest rate strategy because of renewed hostilities in the Hormuz Strait.
Which is a massive global choke point for oil.
Exactly.
A sudden supply shock there could instantly spike global energy prices, which would, pour gasoline directly back onto that month-to-month inflation momentum we just said was cooling.
So if the macroeconomic picture is this fragile, with central banks trapped between slowing growth and cumulative inflation, it perfectly frames the massive tug-of-war happening in the markets today.
We are seeing heavy hitters taking completely opposite sides of the trade right now.
Yeah, let's look at the big short versus the big surge. Michael Burry is sounding the alarm again. He's betting heavily against the current market rally and issuing this stark warning of a potential 1987-type crash.
And a 1987-style crash is a very specific type of structural warning.
How so?
Well, Black Monday in 1987 was not caused by a sudden fundamental collapse in the underlying American economy. It was a structural market crash driven by something called portfolio insurance.
Oh, right, the early algorithms.
Exactly. Institutional investors were using early computer models to automatically short the market as prices fell, ostensibly to protect their portfolios. But because everyone's computers executed the same strategies simultaneously,
The selling just fed on itself.
yes, draining all liquidity and causing a catastrophic doom loop. So Burry is essentially arguing that the underlying structure of today's market, with algorithmic trading and massive concentration in just a few tech stocks, is similarly fragile.
But hold on, how can Burry claim the structure is rotting when the actual corporate earnings driving this current rally are very real?
That's the million-dollar question.
Right. Because CNBC attributes the broader market surge to 5 key reasons, driven heavily by positive Q2 earnings reports and resilient consumer spending data.
Yeah.
These aren't just speculative bubbles. I mean, companies are pulling in billions of actual dollars. Isn't Burry ignoring the very real profits happening right now in favor of, like, a theoretical structural doom loop? Are investors just wearing rose-colored glasses?
Well, both realities are actually coexisting right now, and that is the danger for investors who only look at one side of the coin.
Okay.
The 5 reasons for the surge, the
Yeah.
positive earnings, the consumer data, they create immense short-term liquidity and euphoria. Companies are undeniably making money today, but Burry is looking at the long-term structural concentration.
The fact that a few companies are holding up the entire market.
Exactly. When you have an entire market index relying on a narrowing group of mega-cap tech stocks to drive nearly all of its gains, and a Federal Reserve walking a tightrope, any sudden shock.
Like that oil spike from the Hormuz Strait.
Yes, a shock like that can cause the liquidity to vanish instantly.
So the earnings are propping up the market, but the architecture holding those earnings is incredibly concentrated. If one pillar cracks, the algorithmic selling could trigger the exact kind of automated cascade Burry is warning about.
That is the structural risk. And understanding both perspectives is crucial for you as an investor. Recognizing the short-term reality of strong earnings prevents you from missing out on compounding growth. But understanding Burry's structural warning means you aren't completely blindsided if the liquidity suddenly dries up.
Got it. Now, if Burry is right and the foundation is dangerously concentrated, you would expect to see cracks in those strongest pillars first.
And we are.
Yeah, today we are actually seeing the first major stress fractures in the Magnificent Seven. The monolith of big tech is breaking apart, which brings us back to that massive paradox with Apple.
We are seeing a real divergence in how the market is treating these companies. They are no longer moving in lockstep at all.
Here's where it gets really interesting. Let's break down the mechanics of this tech fracture. Apple is one of today's absolute biggest losers, plummeting 10%.
Despite record earnings.
Right. They reported record earnings, they maintained healthy margins, consumer demand for their physical products is still incredibly massive, but the stock dropped entirely due to disappointing future guidance.
Yeah.
Conversely, on the exact same day, NVDA is a top gainer. The reason? Demand for AI tokens is completely smashing all Wall Street forecasts.
It's a massive shift.
It is, and Amazon and Meta are also taking hits today amid growing arguments that the Magnificent Seven are vastly overvalued, while Tesla and Microsoft are seeing fierce, highly active trading as the market debates their true valuations.
You know, the contrast between Apple and NVIDIA today is a textbook masterclass in how stock valuation actually functions under the hood. It illustrates why a company can have a historic, record-breaking quarter and still see its value wiped out in seconds.
But it still feels completely irrational to punish a company for making record profits. I mean, they put actual money in the bank.
If we connect this to the bigger picture, it makes perfect rational sense. Markets are forward-looking mechanisms.
Oh.
When you buy a share of a company, you are not buying a piece of what they achieved yesterday. You are buying the present value of all the cash that company will ever generate in the future.
Right, Wall Street is all about tomorrow.
Exactly. Financial analysts use models to estimate every dollar of future growth and discount it back to today's value. Apple is a mature consumer hardware company. Their record earnings reflect the past 3 months, but their weak guidance essentially told the market that the trajectory of their future growth is flattening.
Ah.
So the mathematical present value of the entire company instantly re-rates downward, regardless of the cash they just banked.
So the market is looking at Apple and saying, you won yesterday, but your growth ceiling is lowering. Meanwhile, NVIDIA is completely unconstrained by a ceiling right now.
NVIDIA is at the center of a foundational infrastructure shift. You mentioned AI token demand smashing forecasts. To understand why that matters, we need to look at what an AI token actually is.
Yeah, what is a token in this context?
A token is essentially the basic unit of data, like a piece of a word, that a large language model processes. Every single time a user types a prompt into an AI or an enterprise runs an automated AI workflow, it requires massive amounts of processing power to compute those millions of tokens.
And NVIDIA is the one building the engine to process them.
NVIDIA makes the graphics processing units, the GPUs, that act as the physical brain computing those tokens. The market isn't looking at NVIDIA's past, it's looking at an insatiable, exponential future demand for computing power.
It's a gold rush, and they sell the shovels.
Exactly. We are witnessing a massive reallocation of capital. Institutional money is rotating out of mature consumer hardware, like Apple, and pouring directly into the picks and shovels of the AI infrastructure, like NVIDIA.
The Magnificent Seven is fracturing based on who is selling gadgets to consumers today versus who is building the underlying architecture of tomorrow, which makes the passive strategy of just buying a big tech index fund and ignoring it a lot more precarious than it was 2 years ago.
It requires a much more active understanding of where a company sits in the technological supply chain.
So if the tech giants are fracturing and the macro economy is a confusing mess of contradictory inflation signals, how is the smart money navigating this? Let's turn to the Berkshire blueprint.
Oh, this is fascinating.
Right. We are looking at the recent playbook from Berkshire Hathaway under CEO Groq AI, and the strategy outlined in The Motley Fool is incredibly revealing.
Berkshire Hathaway's portfolio shifts are always a masterclass in reading the structural winds of the market, especially during periods of extreme cross-currents.
They are executing a very specific three-pronged strategy. First, they have poured a massive $23 billion into Alphabet, Google's parent company, making it one of today's top gainers.
Yeah, that's a huge move.
They clearly see strong financials and a more attractive valuation there compared to the rest of the fractured tech sector. Second, the Motley Fool notes a broader strategic rotation out of the overvalued segments of the Magnificent Seven and into highly stable consumer staples as a hedge against volatility.
Right.
Procter & Gamble and Coca-Cola are the prime targets, with Procter & Gamble actually popping today as a top gainer.
Moving into consumer staples is a classic defensive maneuver. When you have a market priced for absolute perfection, any tiny misstep causes a 10% drop, like we just saw with Apple.
Yep.
Toilet paper and soda do not require perfection. They do not rely on zero interest rate policies or exponential growth models. They simply require humans to keep existing and purchasing daily necessities.
True.
They offer stability, reliable dividends, and a safe harbor when the economic dashboard is flashing mixed signals.
Look, I understand the defensive play, but shifting capital from cutting-edge AI down to laundry detergent and soda feels like admitting defeat on tech growth, or just stepping out of the race entirely.
Whoa.
It's the third prong of the Berkshire strategy that I really want to dissect, because they are aggressively holding on to their energy assets.
Right.
They are not selling, they are deeply entrenched in energy. Why is holding old-school energy and utility assets their major play right now?
This raises an important question about what it actually means to invest in tech in 2026. The true brilliance of the Berkshire strategy is realizing that energy is a tech play.
Wait, really? Energy is tech?
Think about it. We just discussed NVIDIA and the staggering forecast-smashing demand for AI tokens. How do you physically process millions of AI tokens a second? You build massive warehouse-sized data centers filled with tens of thousands of GPUs running 24 hours a day, 7 days a week.
Oh, wow. And those servers have to be powered by something.
They require immense, unprecedented amounts of electricity. The single biggest bottleneck to the artificial intelligence revolution is not software innovation, it is the physical power grid. You can write the most advanced, world-changing AI algorithms on the planet, but if you do not have the megawatts to power the data center, the software is utterly useless.
So Berkshire is essentially betting that no matter which AI software company ultimately wins the arms race, every single one of them is going to have to pay the electric bill.
Exactly. By holding aggressively onto energy and utility assets, Berkshire is executing a backdoor play into the tech revolution. They do not have to guess if Google, Microsoft, or a brand new startup will dominate the AI space. They just have to own the toll road, the physical electricity that every single competitor needs to survive.
They are balancing the infrastructural tech play with Alphabet for software valuation, while anchoring the rest of the ship with consumer staples to weather any macroeconomic storms or inflation spikes from places like the Hormuz Strait.
It is a highly sophisticated, deeply insulated defense against a completely murky economy.
So, what does this all mean for you listening right now? If you hold the Magnificent Seven in your 401k or your personal portfolio, understanding this market shift is vital.
It really is.
The era of blindly riding a monolithic tech wave is over. The pillars are fracturing. Protecting your wealth amid conflicting inflation data and wild market surges means recognizing the real structural rotation taking place away from mature consumer hardware and toward energy, AI infrastructure, and defensive consumer staples. You need to look under the hood of your index funds and know exactly what you own and why it is there.
The headlines will always focus on the shiny new consumer tech product or the latest doom and gloom crash prediction. But real structural wealth is built by understanding the underlying mechanics of where capital is actually flowing, often quietly, in the background.
Which brings us to the end of today's deep dive. But we want to leave you with a final thought to ponder long after you finish listening.
Think about the physical limitations of our increasingly digital world. If the cutting-edge AI revolution is entirely bottlenecked by the physical electricity grid, will the greatest tech fortunes of the next decade actually be made by the old-school utility and energy companies powering them?
Something to think about the next time you turn on the lights. That's all for today's deep dive of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.